happy International Women's Day to everyone who is joining us. And thank you so much for joining us today for Women's Wealth Investing Basics for Women. So I will be hosting along with my colleague Kelly. My name is Melissa Laursen. I'm on the advice team here at PWL Capital, and we help Canadians with reaching their financial goals with the ultimate aim to live happier and more fulfilled lives. So, as much as our session today will be focused on the investing piece, that is just a piece in the greater puzzle of setting your financial goals and, like I said, living happier and more fulfilled lives. So, I'm going to let Kelly Thomas introduce herself as well.
Great, thanks, Melissa. So I'm Kelly, and I've been with PWL for about 8 months now, and it was an amazing transition. I love it here. I find it really cool that 45% of our firm is actually women, and 50% of our leadership and management team is made of women. And that just makes me feel so happy to see in this industry, because women are not in this industry a lot, and it's really important that we foster an environment that we can grow and develop. So I love working here. It's been great. So today we're going to be using a program called Mentimeter. If everyone could either use your cell phone to scan the QR code on the screen, or if you're on the computer, go to menti.com and put in the code 5823 8017. It's a great opportunity for us to interact with you during the webinar. Feel free to use the Zoom chat option. We will have someone moderating. Joel is helping us out today. But the main way we would like you to engage is using Mentimeter. It's a really great way to follow along and be involved. So to kick things off, I would love to hear from everybody. How confident are you in your investment knowledge?
Wow, we got a couple quick responses here. So that's great.
This is
Love to see this
fantastic.
engagement. This is great. So very, very spread out. We have some very confident, some people who are kind of more in the middle, it looks like. Right, we're getting
Yeah,
a
this
few
is
more in the middle
great.
here. So we will leave this up just for a minute as we see the responses come in. And keep in mind the QR code is still there. So if you're joining us a little later, you can still scan the QR code, join us on Mentimeter to be able to answer these questions with us.
Fantastic.
Pretty spread out, pretty spread out.
Mhm.
It's interesting to see.
Okay, so today we're going to be going over quite a few different topics. We're going to be talking about women as investors and how we differ from men. We're going to be taking a look at what you need to do before you start investing, why it's important to invest, some investment strategies, a how to get started guide. We're going to have some question and answer time. And then at the end, we're going to have a feedback survey. We would love to hear from you about what you thought of today and if there's anything we could do differently or things you'd like to see in the future from us.
Yeah, absolutely. And that is really important to us because we're both very passionate about creating more content for women. And so as we get started with doing more of these webinars, we would love that feedback to see what it is you want to hear more about. Ultimately, we do want to engage women more in these conversations. And we have these overarching goals for you today. When you come out of this 1 hour session, what do we want you to take with you? One is this idea that investing can be simple. It doesn't have to be complicated. Markets work. We're going to get into talking about that. Another is find your people, find the people you can trust, find the experts in this field that you can learn from and you can grow your knowledge base from, and keep those conversations up with people in your life as well. And then a big one is be confident in your abilities. So you're going to hear us talk a lot about confidence today and how that plays into this topic of investing. And this is really important. So I do hope, if nothing else, what you take from this hour is that you come out feeling a little bit more confident in your knowledge, in your abilities. Ultimately, vulnerability is your financial superpower. So, this is something I was talking to a colleague about just yesterday, but what makes women different. And we are going to get into some of those topics today. Sometimes I think when we talk about women and finances or women and investing, we tend to focus on the negative aspects, but really women can be great investors, and we're going to get into why that is. And part of that is being vulnerable. So part of that is sharing the good and the bad, admitting when you don't know something, asking questions. So that's really something that we're hoping today is that everyone is comfortable asking the questions. If we don't get to your questions today, you can follow up with us and we can dive into whatever it is you want to know. But not just today, like I said, with people in your life as well. Just continue these conversations and know that being open and asking the questions is only going to help you to improve. So, with that, we're going to talk a little bit specifically about the research on women and why is it that we wanted to do this presentation today specifically for women? What makes us a little bit different? Why is it maybe that we need a different approach to our finances? So, one thing that's really interesting to look at is that there is a financial literacy gap between men and women around the world. Each country is a little bit different, and this chart here shows just the G20 countries. And I will direct your attention all the way to the right where you're going to see Canada. And you might notice the gap between financial literacy of men and women is largest in Canada out of all of the G20 countries. So the blue line, the dark blue, represents men's scores on financial literacy tests, and the red line represents women's scores. Overall, we seem to have pretty good financial literacy compared to a lot of other countries, but there is a pretty large gap. So this is, part of why we're doing this and part of why we have this Women in Wealth initiative here at PWL is we want to help to bridge that gap and improve knowledge and confidence for women in their financial knowledge. So when it comes to why is this gap? I think there are a lot of different reasons. Part of it is going to be experience and history, right? So women have not been able to even, be involved in managing finances for a long time throughout history. And as much as things are changing now, so, way back when we couldn't open bank accounts, we couldn't own property. We've come a long way, that's for sure. However, women are still not as involved in the financial decision making in their families, especially when it comes to investing. So if we're not involved, if we're not seeing ourselves reflected in, the people we see in finance, in the experts, in the content that's out there, it is going to be more difficult to learn and to find that knowledge that is going to make sense for us. However, there is maybe another reason behind this gap as well. So we're going to go to the next slide here. And this is where we're going to start to talk about confidence. So there have been studies that have been done that show women tend to be less confident in their financial knowledge and their investing abilities. And one study really stuck out to me when I first learned about this. This was something that, really, really hit home. So I actually grabbed a quote here from that study. It says, women tend to disproportionately respond do not know to questions measuring financial knowledge, but when this response option is unavailable, they often choose the correct answer. So just, sitting with that for a moment here, and I see some people reacting to that. This might also, you may relate to this feeling as well. So women are more likely to doubt themselves and to doubt their knowledge, even if they actually do possess that. So I think a big part of that gap that we see in financial knowledge and even in participation actually comes back to this lack of confidence. Even putting the research aside, I've definitely seen this throughout my life and throughout different experiences, even with female colleagues and females who are in the industry who I look up to, who are experts in their field. Sometimes, they will share that they don't feel confident and they don't feel as confident as their male colleagues. And you know, this is really tough because that lack of confidence sometimes can hold us back. In some cases, it can even hold us back from investing and from taking those steps that are going to help us reach our financial goals and reach, you know, those goals for our lives that we have. One way that that tends to be reflected is women are a bit more intimidated or fearful of investing and tend to have a lower risk tolerance than men. Now, this isn't all bad, right? And actually, you know, having a bit of that vulnerability and that ability to, you know, to say when you don't understand something, that can actually be a good thing. One thing that we have seen in the research is that when women actually do get started with investing, they often actually outperform men because they're better at doing things like sticking with a strategy. They're not overconfident, so they're not going in and trading a lot and trying to figure out what the, you know, the best hot stock is going to be. So actually they're very good at following a more passive strategy, which we're going to talk about later. So I think women, and I think what's really important for us to realize is we do possess so many skills and so much knowledge already that can help us meet our financial goals, can help us to be better investors. So we just need to take that little step to be a bit more confident in ourselves to at least actually get going on this. Go to the next slide here. And so I have another Mentimeter question for you. And, you know, just as a reminder, you can go to menti.com on your phone, put in the code that's up at the top here. I know Joel shared it in the chat as well. And you can answer this question. Have you ever taken time off of a job or out of a career to care for loved ones? So this might be taking time to care for children, maybe for parents or someone else in your life. Right, so we're seeing some answers coming in here. It's a mix, but we have a lot of yeses already in the group. I would imagine, I think some of you are also on the younger side, so may not even have, you know, faced the situation or this decision yet. But yeah, that's really interesting to see. All right, so this brings me to our next point of why it's important to talk to women about money and how we might have somewhat different planning needs than the men in our lives. One of them is that women tend to live longer. Yay, that's great, right? That seems like a really good thing. But of course, when it comes to our finances, what does this mean? It means that we have a longer period of retirement that we need to plan for. So we have a longer life, more years that we're going to need to be, you know, setting aside money to sustain ourselves in the future. So we're likely going to need to save more for that reason. There are also a couple of reasons why we may have lower incomes throughout our lives. One of them is what we were just looking at, is caregiving. So women do disproportionately tend to take more time off caring for their children, maybe caring for elderly parents or other loved ones. And this has actually been measured, and it's shown that most women will probably on average lose out on more than $200,000 of income through their lives because of time taken out for caregiving. So, you know, I think the more obvious piece would be taking a year off for maternity or parental leave. Of course, that's going to reduce your income in that time. But also, how does it impact your career going forward, the opportunities you have, you know, the opportunities for promotions and whatnot. So all of that can also play into lower incomes throughout our lives. Finally, the effects of divorce. So divorce has been shown to disproportionately impact women more than men. For both men and women, if they go through a divorce, it tends to have a negative impact on their financial situation. But for men, it's much more minor, whereas women are impacted in a larger way. So for all of these reasons, having lower incomes, longer life expectancies that we need to plan for, women are going to need to save more, probably a larger portion of their incomes throughout their lives, and also be very smart with how they are investing that for the future. So it's a big reason why we want to get into these topics today. So before we really dive into the fundamentals of investing, we do want to mention really important that before you start investing, there are a few things you need to do. One is you want to have your high interest debt paid off. So this could be something like a credit card balance that you are carrying at a really high interest rate. Often credit cards are close to 20%. You're not going to be getting any guaranteed investment returns close to 20%. Okay, so if someone is promising you that, be very skeptical. So you're much better off paying off that high interest debt first. You also want to make sure that you have some cash saved for an emergency fund and for any short term goals that you have. So, if you have a short term goal, something that's going to be happening within the next couple of years, you want that money to be accessible when you need it and you don't want it to be dropping in value before you need it. So, it makes sense to put this somewhere like a high interest savings account where it is going to be available for those short term goals. As you get into longer term, medium, longer term goals, then it can make more sense to look at investing, but you definitely have to look at your specific situation, your timeline, and how much flexibility you have on that timeline for those goals. Lastly, an emergency fund is really important for everybody to have. A good rule of thumb is to have somewhere between 3 to 6 months worth of expenses, but it's definitely going to vary depending on your specific situation. So you'll want to think about factors such as how stable is your job? Do you have a partner who's also bringing in an income? Do you have other ways to access cash if you had an emergency? So all of those factors are going to come into your decision for how much of an emergency fund to put aside. And it's really important to note, again, you want that in cash. You want that somewhere like a high interest savings account where it's accessible, it's available to you, it's not going to lose money. So before we start investing, just make sure we have these taken care of first.
Amazing. Thanks, Melissa. So the next thing you want to do once you've set aside money for your short-term goals, you've created an emergency fund, why would you want to invest? One of the big reasons is you need to have money available later in life when you may not have an income coming in. When we talk about investing, we're usually talking about investing for the long term. For most people, retirement is the big one. Most of us don't want to work forever. And even if we do, our health might not allow for it. So we need to make sure that we've got something set aside for when we no longer have an income coming in. So one thing that's really important to keep in mind when you are investing is the power of inflation. If we look at 50 years ago, the cost of a cup of coffee was about 25 cents. Today, it's closer to $2. So the buying power of your money loses ability over time. So we want to make sure that when you're investing, that you're investing your money so that it keeps up with inflation. Inflation can be both good and bad. When inflation gets high, it's bad because it makes it difficult for people to buy things that they need. It also makes the value of your savings worth less because everything else costs more. Inflation can be good if you owe money. It means that the money you borrowed becomes worth less. So if we look over the last 50 years or so, things have become 7 times more expensive. How much do you think stocks have grown in that time? Use the Mentimeter here to answer the question.
And just keep in mind, this is a diversified portfolio of stocks. We're not looking at one particular stock, just the stock market as a whole.
Yeah. Okay, so we've got a variety of answers here.
Right, once again, kind of spread out. I do really like the colors on this, by the way. The colors for these answers, nice and bright.
Okay, so we're going to take a look. And the answer is actually over 150 times the stock market has grown.
Got one
So,
person got it right at the end there.
right. Yeah, one person. So this might be surprising for everybody, but the stock market has grown over 161 times in the last 50 years. So if we look at this graph here with the inflation, it's grown about 7 times. So if you had invested in the stock market in 1970, say you put $1,000 into the stock market, it would have grown 161 times, and you would have had $161,000 in the last 50 years. So that is the power of investing. Now, just keep in mind that when you are investing, it's not going to be a straight line. You can see in this graph that there are ups and downs, and it's important for the long term that you take advantage of those market recoveries. So not pulling money out when the market drops and keeping the money invested for the long term so you can see that growth. So I've got another question here for everybody. I want you to think about when you retire, how much do you think you're going to need to have saved before you retire? This is a really general question. There's no right or wrong answer. Just to give an idea of what you think you need to have set aside before you stop working. It's
Interesting.
really
We've got
interesting.
yeah, a lot of people in the higher amounts there.
And everybody's got different goals in retirement and how they want to spend their time. So it's really interesting to see what people like to set aside for that. Fantastic. So this is a rule of thumb. It's a very high level example of a couple who are 28 years old and retiring at the age of 65 with only the Canadian pension plan and old age security as incomes coming in and no external pensions from an employer. So what we call a no frills retirement, their desired income is only $24,000 a year, which is funded through the CPP and OAS. They wouldn't need to have anything set aside before they retire. Now, if you're looking for something a bit more deluxe, which we've called it here, you'd want to have about $100,000 of income every year. We would be looking at a savings before you retire of about $1,750,000. $50,000, sorry. And this is by putting money aside every month, about $1,300, when you're getting a return of 5%. 5% is just an average rate of return we could expect investing in the market. But just as a view, this is something you could look to expect by putting money aside every month. So if this couple was saving money, $500 a month from age 28 to age 65, how much would they have depending on what investment strategy they used? Say they were just putting money under their mattress. They didn't like investing in the stock market. They didn't trust it. They were afraid of it. They wouldn't get any return on their money, and they would make about $222,000 just by saving $500 a month. Now, say they were really low risk investor, wanted something very conservative, and were just putting it in a high interest savings account or maybe some GICs, they could expect probably a 3% return, and they would, after that time, have about $407,000. Now, if they invested for the long term in a diversified portfolio, they could expect somewhere around 6%. That would grow their 500 monthly contribution to over $819,000. This is the power of the market and investing long term.
Okay, so we have more of an open-ended question for you right now. When you think about investing in stocks, what's the first thing that comes to mind? A word, a phrase, complex, uncertainty, right? Interesting. Mutual funds, ETFs, risky, overwhelming, risk, all-in-one ETF, better to be in an index fund. Okay, we have some people here who maybe are familiar with PWL content and our philosophy as well. Research, lots of research. Okay, volatility, growth. Okay, these are all really interesting. I see risk come up a few times. which is common, which is often, one of the most common answers that we get. Complex again. I always have to watch. Okay, yeah, this is really
This is really
interesting.
interesting.
And yeah, I think it's really a range. Certainly, we have a range. We saw that early on as well in the confidence levels and the experience levels of our audience. I would say, overall, a lot of them do have to do with risk, complexity, uncertainty, and maybe a little bit more negative, but we definitely have some people too that are thinking more specific strategies. So that is interesting. So we'll go on to the next slide here. And this is where we're going to get into more of the basics of what are stocks and bonds. And we're going to talk about this question, this age-old question. Can you find the good stocks? Can you pick the right stocks? And so we're going to discuss that idea. So I know that we have people with a lot of different knowledge levels and experience levels here, but just to go back to the basics and make sure everyone knows, what are we talking about when we talk about investing in stocks or in bonds? So ultimately, when you are investing in stocks, you are buying ownership in a company. Okay, so you are gaining equity or ownership, a piece of ownership in that business. Whereas if you buy bonds, you are loaning money. So you are a lender in that case. When we think about a loan, how does that usually work? You would lend money at a certain interest rate. Okay, so that could be set or that could be a floating or variable rate, but you would expect to receive some amount of interest and eventually to get your money back that you lent. When it comes to ownership in a company, there's a lot more variability in terms of what can happen with that. So if you invest in a business and you buy ownership in a business, that business could potentially do really well and you could multiply your investment, or that business could fail. And we know there are a lot of businesses that do fail. So you could completely lose that investment. So it's really going to depend on how well does that company do. That is going to impact the return that you're going to get on that investment. So let's take an example, a look at an example here for this. But what does this mean? So let's say your friend, she would like to start a little coffee shop in your town. So it's going to be called ABC Coffee Company. You've known her for a long time. You believe in her. You think she has a lot of potential to be a great business owner here. And she approaches you. She knows maybe you just came into some money, you got an inheritance. So she approaches you to invest in her new coffee company. She needs about $100,000 in order to do things like buy the equipment she needs. Maybe she's going to sign a lease or purchase a building to use, just to hire staff, figure out how to expand, maybe market her business. So all of these are going to require money, right? Require some capital. So let's say that you do want to invest in her business. We have these two options. Do you want to buy stock? Do you want to become an equity owner in her business? Or do you want to lend her the money like a bondholder would? So if you do decide to go the equity route, buying stock or ownership in the business, this has the potential to do really well. Let's say that her coffee business, it takes off. She ends up expanding into different markets and different towns. If you invest $100,000, you potentially make a lot of money. That could be, tripled or times 10. Sky's the limit how well you could potentially do. Now, we know that's not the case with most businesses, and we do see a lot of businesses fail. So that $100,000 you invested could go completely to zero and you could lose everything. So another option you might consider would be to lend the money to this friend. So let's say you lend the $100,000. You could set an interest rate, just as an example, let's say you ask her to pay you 5% interest every year and then pay back your 100,000 at the end of a certain period. Now, with that, there's still risk. Okay, so it's not that this is completely conservative, riskless investment. That business still could potentially, collapse, not do well at all, but they would have the need to pay back those bond holders, those lenders first before any equity holders. So they might go, let's say, and sell the equipment that they had to try to recover some of that. So you do have a higher chance of recovering your money. On the flip side, if they do really well, you're not going to get anything more than that 5% interest that you agreed on. Okay, so there's a smaller range of outcomes. It's not without risk, but it is the less risky option when compared to stocks. So we're going to kind of focus more so on stocks and investing in the stock market over the next few slides. But do just keep in mind, we're going to talk later a little bit about what is your risk tolerance and the kind of asset allocation you might invest in. So you are going to be considering your mix between stocks and bonds when you're thinking about that. But let's focus now on the stock market. Okay, and this slide, this visual here is to represent the idea that most stocks are bad investments. So you're going to hear, us say a lot today that it's really important to get investing, right? And that's a big reason why we wanted to do this presentation. Okay? Investing can have a lot of potential upside. It can be really important to achieving our goals. But when we're talking about that, we're really talking about investing in a diversified portfolio, not going out and trying to pick the winners or pick what you think are going to be the best stocks. Ultimately, most stocks are bad investments. So when you look at this graph here, you can see that only 20% of the stocks over this time period, 1989 to 2015, accounted for all of the gains and growth of the overall market. So you can kind of think about it, 20% of those stocks really were the winners that were going to help you grow your money. The other 80%, I'm going to call them duds. Okay. So the other 80%, they underperformed the market. Maybe they even lost money. Okay. And actually 40% lost money over this time period. So it's really hard to pick the winners. And we're going to look later at even people who are working in the field, are experts in the field, get paid to do this, even they have a very hard time doing it. And this is largely because most stocks are bad investments, but the market as a whole has been shown to be a good investment over the long run. So this is definitely over the long run. We're going to keep hammering that in, that you should only be investing if you have long-term goals. All right, so we have another question for you, and this might relate a little bit to the last one that we had. What is your current investment strategy? What do you usually do right now? So we have someone else does it for me. We have index funds. Yeah, we saw some people mentioning index funds and ETFs earlier. So there are other ways you can invest, of course. We didn't want to put too many options all on one slide here, but you might be investing in real estate, crypto, lots of potentials there. Gold, maybe. Some people don't have an investing strategy, or maybe you don't have one yet, you might say. Okay, we don't have any stock pickers. Interesting. Okay, well, this is what happens when we have a more female audience. We tend not to get the stock pickers as much. Okay, so that's really interesting. So that definitely does kind of align with the research that we've talked about, where we do see men showing more tendencies of overconfidence and going out and trying to pick those stocks. And actually, just as we go to the next slide, I think I'll tell a little story from back when I was a teacher. So I was a high school teacher for 10 years prior to this change of career. And I ran a personal finance club for my students. Now, every semester, I would get a different group of students who would join. And really, I had it very much as a student-led club. So we would discuss what they wanted to talk about. So I didn't have a set agenda necessarily. It was all about, okay, what do they want to discuss? And one semester I had all boys in this club. And all they wanted to talk about was how to pick stocks and invest in cryptocurrency. That was that was the entire semester what they wanted to talk about. Of course, I did try to throw in some lessons there, maybe about passive investing, which we'll get to. But it was just really interesting to see that that was their interest. And there was another semester where I had an all-female group in this club, and they wanted to talk about much more practical skills, like how to budget, how to pay down debt. It was really all about what it was that they could control. And I think that that's an important lesson because when it comes to investing, there are a lot of things that you're not going to be able to control. And especially when it comes to stock picking and how a company is going to perform. Even the overall market, like Kelly was talking about before, there are going to be down periods and you can't control that. But what can you control? Your own actions, your own behavior, sticking with your strategy, not pulling it out when you think the market's going down, staying invested in what you had found was going to be right for you and for your goals. So I just thought, I've really seen these different types of behaviors. And so it's kind of interesting to see how it relates to everybody's answers here as well. So just going to the next slide here. We're going to get into a bit more about what we mean by active and passive investing strategies. You've already heard us referencing it a little bit here. We saw some people answering before that they were holding index funds and exchange traded funds. So let's talk about the difference between active and passive. An active investment strategy means that you are trying to beat the market. You are trying to go and pick what you think is going to be the best investment over the next little while. Maybe you're trying to time the market. So maybe you're trying to figure out when's a good time to invest? When's a good time to sell? Do I think things are going to go up or down over the next year? So that is what we mean by the active strategy. And there are a lot of actively managed mutual funds. So a lot of investments out there that are very common that have active managers, and this is what they are trying to do. Whereas you can also follow a passive strategy. So those of you who answered that you invest in index funds, you are probably following a passive strategy where you just want to follow the market and capture what it is that the market is going to give you. And like we mentioned before, markets work. We do have these positive expected returns over a long time horizon. And typically, it's been shown that following this passive strategy is actually going to help you be better off. And as I mentioned before, women are quite good actually at following these kinds of passive strategies in part because we don't suffer so much from that overconfidence bias. So let's look at some information here to back up these ideas. What percentage of active managers do you think beat the markets over a 10-year period in the United States? Okay, I love that. Some people are ready. They're ready with their phones. They're ready with Mentimeter. They're getting these answers in right away. Amazing.
A few
Okay, so
people in the middle there.
yeah, we had a few right in the middle, somewhere around the 50% mark. We have a bunch of people kind of clustering lower on. All right, let's check out what the answer is to this question. 2%. It looks like some people actually guessed that right on. Maybe they've come to some of these webinars before, or they've
That's
just
amazing.
really been following the research. Yeah, so it's only 2%. So let's take a look a little more in detail at the numbers. This is going to differ whether we're looking at the Canadian stock market, the US, or international. But I think what I really want everyone to take away from this graph here is what happens over time. So if we start out looking at the 1 year mark of how many active managers outperform the market as a whole, the 1 year mark, it seems like it's not too bad, right? Somewhere within the 30 to 50% range, depending whether we're looking at international, US, or Canadian. So, after 1 year, you might look at that and say, oh, some of these people are doing pretty well. Some of these people seem to know what they're doing. However, what happens over time, I think, is very telling and very important to see. Over time, as we get into these longer time horizons, the active managers outperform less and less and less. Anyone really in the short term can take a bet and, have about a 50-50 chance of getting lucky, right? If you go and you flip a coin and you're going to call heads or tails, well, half the time you're going to get that right and you're going to win. Now, winning one time doesn't mean that you have some special skill or some special ability to outperform, but there's always going to be someone who's getting lucky, who's on the right side of that coin flip at any time. Now, over time, if you do that coin flip over and over and over and over again, what are the chances that you're going to constantly be getting that right? It's gonna go down more and more and more. You're still always gonna have that happen chance, but it's going to go down over time. So as we look at these longer time horizons, we see that active managers, they are not outperforming the market or very, very rarely. And even if there are those, those couple, it's very hard to spot that. Okay, just because someone has done well in the past does not mean that they're going to do well in the future. And something else we're going to talk about is often they are charging high fees for this. So we are going to get into how the fees are also going to impact your performance over time. So let's look at this because this is huge. When we look at an investor over a long time horizon, what is going to be the most impactful on how well they do is going to be the fees that they are paying. I would say, just starting off, before we get into the numbers here, it is so important to know what you are paying. And we see a lot of people, in our own lives or, just, coming in to talk to us about advice. We see a lot of people who are not really aware of what they're paying. So they might think they're paying an advisor nothing or something really low, and they don't see the fees that are embedded in the products and in the funds that they are invested in. So I would just, really urge everybody, if you are investing already, if you are, holding mutual funds or whatever it is, to look closely at what the fees are that you're being charged and what are you paying for. Okay, so that's also really important. There's a lot of really valuable advice that can come from people in the industry that can be really helpful for getting you to reaching those goals. However, are you paying for that advice and for the financial planning and for everything that goes along with that? Or are you really just paying for the investments and the investment outperformance, if that is what they are promising to you? Because as we've seen, often active management isn't necessarily going to be effective. So now let's dig into some of the numbers, and you'll see that the blue line represents someone who is investing $100,000 over a 30-year period, making average annual returns of 6% and paying no fees. Okay, so the blue line represents if you were paying no fees, you would end up with just shy of $575,000 at the end of that 30-year period. The red line represents paying 0.25% fees or annual cost. You'll notice that that red line is very close to the blue. It doesn't make a huge impact paying that level of fees. Now, that fee level, 0.25%, that's going to be very close to what you might expect on something like an exchange traded fund that is tracking an index. So more of that passive strategy that we talked about. There are a lot of exchange traded funds out there that are going to be charging somewhere in that range, those lower levels of fees. Finally, we have the green line. So the green line represents paying 2.22% annual costs. And this is quite common for actively managed mutual funds, especially here in Canada. So here in Canada, most people who are investing in actively managed mutual funds are probably paying over 2%. And you can see how much of an impact that has on your growth over, especially over this long time horizon. So often when we talk about the benefits of investing, we talk about the power of compound interest, right? And having those investment returns compound over time. But the same goes for fees. If you're paying fees, that is going to really eat into how much you have and how much you are left with at the end of this long time horizon. So just looking at those differences, especially between the green and the red lines, okay? So if you pay 2.22%, you'll be left with less than $300,000. If you pay 0.25%, you would be left with 532,000. That's going to have a pretty big impact on your retirement. Okay, so this would be if you had the same annual average returns over time. Fees are important. Okay, so I'm going to say it again. Make sure you know what you're paying for, whether you're getting value out of that, because it's going to have a huge impact. So finally, what should you do? We've been talking about this already. It's probably no surprise. So we are big fans of an indexing or a passive strategy where you hold a little bit of everything. You have a diversified portfolio. That doesn't just mean holding a whole bunch of stocks within a stock market, but it can also mean diversifying across countries, globally. You can also think about what sort of a mix of stocks and bonds is going to make sense for you. This is all something that you need to talk to an advisor about. You need to figure out, all of your goals, risk tolerance, and whatnot, which Kelly's going to talk about later. But, just keep in mind there are low cost ways to access that. There are exchange traded funds, what we would call asset allocation ETFs or all in one ETFs, they're sometimes referred to, that allow you to get that diversified exposure all in one bucket for a very low fee. Okay, so there are options out there that are not super complex, that aren't going to take a lot of your time or research, to track. I saw people talking about that earlier. Um, and it's important then when you're doing that, that you're not trying to time the market. So we can still be our own worst enemies at times, right? Our behavior is often, the biggest issue we see with investing performance. So you don't want to be timing the markets. You don't want to be trading a lot, keep trading costs low this way, and really just sticking to that indexing or to that passive strategy has been shown to be very effective. And I'll mention it again, women tend to be really good at this. So this is a really good strategy for us to pursue. Ultimately, returns come from the markets, not from the managers. And as we saw, the managers often just add a lot in fees. So with all that, I'm going to pass back to Kelly to talk about some more specific guides and steps you can take.
Great. Thank you, Melissa. So the first thing that you want to do to get started is you really want to establish your long-term goals. We're going to share a link in the chat here, or if you're on your phone, you can click establish long-term goals, and it's going to take you to a survey that we have available. When we talk about long-term goals, we're talking about things over 10 years from now. Like what do you want to make sure that you're funding in your retirement or just later in life? So we want to make sure that you're looking at things that not just things you want to buy, but how do you want your lifestyle to be in retirement? Do you want to be spending more time with family? Do you want to take up any hobbies or creative projects? Do you want to, bring meaning to your life when you're no longer employed? And just making sure that you are still finding yourself and bringing life and pleasure to yourself in retirement. So those are the things that we want to make sure that you have set. And a lot of the times we find with couples that their goals are a bit different in retirement. I remember hosting an event for clients a long time ago where we talked about this, and just seeing the answers between men and women was so interesting. Most men talked about just wanting to have enough money and being able to go on trips during retirement. And then when we spoke with the women in the groups, we heard more about, spending time with family, doing things with their grandkids, or starting new hobbies and just being fulfilled during retirement. It wasn't just about reaching this financial independence. It was more about what they were going to do with that time and making sure that they had the money for that. So it was really interesting. The next thing that you want to do is determine your risk tolerance. Now, Melissa's mentioned this a couple of times, and your risk tolerance is based on a few things. First, we want to take a look at your time horizon. How long do you need this money to work for you? When do you need to start accessing it? The next is we want to take a look at your investment experience. Have you ever invested in the stock market before? Have you ever bought mutual funds or GICs? Like what are you more comfortable with? Is seeing something like when the market dropped 50% in 2008 and 2009 going to keep you up at night? Or are you able to write it out for the long term and see the markets recover? The risk tolerance will help determine the ideal asset allocation or asset mix of stocks and bonds in your portfolio. This is different for everybody. And like I said, it really depends on what you're comfortable with. And just because you may be investing with a partner, it doesn't mean you're going to have the same asset mix either. So you can invest differently than your partner and still make sure that you're achieving your goals. And so there should be a link in the chat here for a risk questionnaire. It's through Vanguard, but it's a great way to have an idea of what your asset mix might look like.
Yeah, and I will just say the other link that Joel shared in the chat for the goals survey is excellent. I've done this myself. Kelly talked about having different goals between partners. So it's good to do if you're single or in partners. It is great and highly recommend trying to check that out.
Thanks, Melissa. So one thing I wanted to talk about was different types of investment accounts that you could be investing in for your retirement or just for the long term. These are just a couple of the options. There are quite a few other options available, but these are the two that we wanted to focus on today, just as the beginning. So the first one is the Registered Retirement Savings Plan. Most people know this as the RRSP account. This is a really amazing account to invest in over the long term because as you are in the workforce and you have a growing income, when you invest in the RRSP, everything that you invest is actually deducted from your income. So it could potentially be very tax efficient for you because you're paying less tax. Now, the thing with that is when you are then in retirement and ideally in a lower income, that's when you take the money out and then you are taxed at a lower income. With the tax-free savings account, this is a great option for long-term savings. Everything that you invest in the tax-free savings account grows tax-free. You can withdraw from this account anytime. There are no restrictions. The only thing with it is that if you take money out, you can put it back in the following year. So say you had a contribution room of $50,000 and you were invested at $50,000. If you wanted to buy a car, say that was one of your short-term goals and you needed 30,000, you could take that 30,000 out to buy the car. You would get that room back just the following calendar year, plus the additional room that you get each year. So this is a great option for short-term or long-term savings that is available out there. So do you feel ready to start investing? If you're feeling confident, there are some really easy ways to get started on your own. There are self-directed brokerages available like Questrade, Wealthsimple, and most big banks have self-directed trading platforms as well. You could go do a little research, review the different trading platforms, look for information about account minimums, trading fees, and account fees, like Melissa mentioned, and then take a look at an all-in-one asset allocation ETF portfolio. Do the risk questionnaire, figure out what kind of mix is right for you, and buy the ETF that matches with that. If you have more questions, we are always happy to help. I've got a link here to book a call with Melissa and we can really help figure out your situation and see if we can help in any way.
Yeah, and I know we only have a few minutes left to go here, but we do have a couple minutes. If you have questions that have come up as we've been going through this content, feel free to put them in through Mentimeter. You can also share them in the chat. Okay, so we'll take a look at that as well, and we'll see if we can briefly get into the questions with the time that we have left. But of course, like we said, you can also book a call. We're happy to help. You can follow up, send us an email, tell us about the specific questions you have, your specific situation. Really, everything that we're covering today is much more general guidelines. It's not specific advice. So, as we mentioned, you do need to speak to someone about your situation before you dive in and make sure you have your own goals, your own risk tolerance, all of that figured out. So we'll just leave this up here for maybe one more minute to see if anyone has questions that they want to put in. But like we said, also feel free just to reach out to us and you can ask the questions that way. I know we just got a comment in the chat saying that this has been lovely and thank you. And so we really do appreciate that. And actually, maybe we'll go to the next slide here since we don't have any questions coming in. We will just mention again, right? Here's the link if you do want to book a call with Kelly and I, and we can chat about anything that you want to know about. It could be comments on the content today, it could be questions that came up, or it could be completely different financial questions. I know that within 1 hour we can't cover everything to do with personal finance, but we would love to get questions about all topics that are related. So we'd be really happy to talk to you. And the one thing that we ask of you today is we would love your feedback. We mentioned early on that the Women in Wealth initiative at PWL Capital is really important to us. We feel that it's important to put out more quality content for women that speaks your language, that discusses the topics you want to hear about. So we would love for you to provide your feedback on this webinar today and especially to tell us about what topics you want to hear more about. So we have a few ideas, that we would love to present on in the future, whether that be future webinars or in-person events, perhaps. But we would really like to just get ideas from you and have you help to, to make that path of what it is that we're going to do. So with Menti, you can click the link. So you'll see if you're following along on Mentimeter on your phone, you can click the link. But I see Joel has also added the link to the Zoom chat. So you can click on it there. It just take a couple of minutes, just a few questions, and we would really like to hear from you.
This has been really fun. We really appreciate everyone who attended. And yeah, we hope that we can do more of these. Both Melissa and I love to, share information and teach others. And so it's really a great opportunity for us to pass on some knowledge.
Absolutely. So we'll just go to the last slide here and we'll close it up for the day. And so once again, thanks so much for taking the time. Happy International Women's Day to everybody. And hopefully we'll hear from you. We can keep these conversations going. Thanks, everyone.
Thank you.